Eastern time, and we are back for May options expiration OPEX live with my good friend Imran Laka. Imran, how are you doing?
Good, man. Good to see you.
I have broken out my meme mania T-shirt, which
Yeah,
I last
I
wore
need to
in
get one of those. I definitely.
2020. Today, we have a giveaway going on. You can get a T-shirt, but anyone else that wants to give a T-shirt, we have a link. I'll be providing that shortly. We're going to raffle away. I got 15 of these bad boys hanging out. And, you got to strike while the iron's hot here. We have meme mania, so let's do it. All right, let's start with the meme stocks because I think that is on everybody's minds. What do you think about everything that is happening in meme land? Here's GameStop. It's up 40%, which is down 40% from today's high, I think.
Amazing.
You got AMC going nuts. You got Reddit stock going crazy. So, what set the stage for us here? What do you think's happening? And then I'll give my 2 cents. I tend to overtalk, so I'm going to let you go first.
I'll be honest, I was a little bit surprised at how much things reacted just from, correct me if I'm wrong, but the guy didn't even actually say much about GameStop. It's just the fact that he's back. It's just everyone crazy. But
I think he's, yeah, let's bring up his Twitter feed real quick. I just want to bring that up on this tab here before. Because someone was saying that he hasn't showed up on any other streams, and I'm kind of like, it would be so awesome if we hear that he was like hacked and that, he's just going crazy now. It's just like constant, like he hadn't posted for 2-something years, and now it's just all these weird redemption things.
That's a very good
point. Talking you, but
that's a very good point, actually, that if his account was hacked, but because if we haven't actually seen him on camera actually saying that he's back and he's got a view about something.
And allegedly that's the thing. I don't know.
Yeah, that's interesting. Because then the whole thing, then it could just give the entire move back, right?
Yes. I also think there's 2 things that I think are going to be that could cause this to reverse very quickly. Number one is it turning out that maybe he's not that involved with this. The other thing, he's seeking redemption. The dude made a lot of money. He earned it, but he made a lot of money. Second one is when Ryan Cohen comes out and starts selling stock, which, CEO of GameStop, I fully expect to see a, Form 4 or whatever from him saying like unloaded into the retail bid, which he tends to do. Those are the 2 things I'm watching.
Yeah, I hear you. So look, I don't think it's going to last. It's just a question of how long will it last. But what it indicates is that there's still an appetite to chase these memes, right? It boils down to 2 words: animal spirits.
Yes.
Right. So if people thought animal spirits were dead, they're wrong, right? They're clearly waiting to be unleashed on the next big thing. Now, for the last 6 months or even longer, let's say probably 6 months, it's definitely been AI has been where that kind of animal spirits has been residing, and there's been pockets of crypto as well. But retail aren't really going after crypto quite the way they have in the past. And then all of a sudden, this stuff comes back and they're there. Now, the point I was making to a friend of mine as well was that we don't even know, obviously retail is participating in this, right? But there's probably a lot of insto, algo, smart money that's cottoned on to these triggers. They built loads of websites like tracking all these Reddit boards and stuff to see what are these retail guys talking about. And so it might actually be a lot of algo type stuff driving these moves because they know that everyone's talking about it and it's going crazy on social media, but it's not actually retail buying all of it, basically, right? So I think that's something we need to be aware of, and that also means it could unwind very, very fast. Right?
Yeah. On your screen here is the implied vol, 1 month implied vol for GameStop. I totally agree with you that the takeaway from all this from us here, and maybe we're not super interested in meme stocks, is that the risk appetite is healthy. We had crypto going pretty strong before. Maybe you could take some macro notes from that, but these things ripping just tell you that there's indeed a risk appetite, because in April, when markets were crashing, everyone was talking about interest rates and geopolitical concerns and all of those things, right? And suddenly the focus was on, more macro equity indicators like S&P price or VIX price or whatever it may be, or VIX levels. And so now we have this populating, which is my takeaway is the same as your. People are trying to get into fast money. But here's the implied vol. The other thing I would note from this is that, stock is here 30-ish. Now it's obviously higher. I thought the reaction function of implied vol was much faster this time around, which I think makes sense. We saw that in previous spurts where these stocks started to go up, which I just think meant that, calls or just implied vol in general, like just widened out a lot faster. And I think that really weighs against the rally because it gives dealers and market makers in theory more padding. It makes calls more expensive. It incentivizes sellers. And so I think that your first point on, retail is involved here, but there's this institutional component that gets much more active in this situation. And I don't think we're going to see a repeat of, 2021. I don't think we ever can see a repeat of that. I just think that these are going to be more flashes in the pan as opposed to new movements.
Yeah.
Someone said that this Twitter account was sold. I don't know if that's right, Edwin Moore, but at any rate, it's really pretty interesting. So a couple of smart guys have pointed out, my friend Noel from Convex Asset Management, he's out there, I know, trading spreads, legging spreads. He said that's going really well. I saw that. I know his name is Chris. I was mispronounced his last name. Is out there. You had mentioned that he was doing something similar. You had mentioned that you were selling some puts in AMC, which that was one of the more successful trades. I thought, the easy, I don't want to say easy, but that was sort of the lower risk trades to make back in 2021 was selling GameStop puts, because I remember people were selling like the 50 strike puts for like $45, and because vol's gotten so crazy. So do you want to walk through like, hey, what are you looking for in AMC where you go, hey, maybe a put sale makes sense, because that's counterintuitive. If you think the stock has gone too crazy, why would you buy puts in that environment? If the stock comes down, one would think you would start to lose money. So you mind walking us through that?
Sure. So I mean, look, so AMC was chilling out at around $2.5, $3 basically, right? And then suddenly this stuff happened and the stock has tripled and it's above 10. I don't know where it is right this minute. It's back. It's already back to 6, right? So it's still double where it was before all this stuff kicked off. Okay. So the point being is, on a day when the stock is up 100%, if your put has not gone down in value and has actually gone up in value, and we're talking about like the 3 strike put, basically far out of the money put, the fact that the stock has doubled and the put hasn't dropped even slightly in price, that's kind of crazy, right? Yeah. And what that tells you is that when we come back down, there's no reason for the put to increase in price either, right? Because it didn't drop in price, right? So why should it need to pick up? Now, I don't know. There is an argument to say, maybe if you look at some of the past price action in these names, they have these pops and then they get sold and then they make new lows, right? So, but it's not like, at $3, it's not like the stock was expensive, right? So it had kind of stabilized down at $3.
Yeah.
No one's had this on their radar that this kind of crap was going to happen, and then suddenly this happens and the stock triples. So I just think you can kind of underwrite the stock at 3 and be quite comfortable. You're getting paid like you're getting paid percentage wise. You're getting paid like nearly 20% premium of where the stock trades. If the stock trades at 3, if you're getting 50, 60 cents to sell that put, you're getting 20% to underwrite the stock. And I don't know, maybe it goes straight back down to 3, but I think there's a decent chance that it finds some support and finds some bids. I mean, if this is a complete hack and it's a complete fake, then maybe not. But if it isn't, then people who would have saw AMC at 10 and now seeing it at 6 are going to be saying, oh, it's a bargain. I'm going to buy it down here, right? And get ready for the next one. So I don't think it hurts you too bad selling puts. I don't think normally the risk reward selling outright puts isn't great. But I think when a stock is that beaten up and then it triples in value and the implied vol goes up by 100, 200 vols, then selling those out of the money puts behaves very differently to selling normal out of the money puts that are not on vols that are in the hundreds, basically.
Yeah, I think the other thing to note about this is that I think we're all in a way conditioned that like when the VIX moves up a little bit, it gets slammed and mean reverts fully. And in this case, when you have these meme manias, this was one of my takeaways from 2021 is that it took a really long time for both the stock price and vol to come all the way back down to, I think, more reasonable levels. And so the reason I bring this up is that I don't think we're going to go from, hey, meme mania to a 0 in the stock. Second, because the stock is already, the strikes are pretty close to zero. I think that messes with the vols a little bit. But I just think that when you're selling this put, the stock is likely to, it's going to give 40% back pretty quickly, but then it's going to hit kind of price levels where it was and then just kind of grind along is what I think is set to happen. And when you get to that grind is when that put that you sold is really going to start to pay off. Because yes, the stock is coming down, but the vol is going to really collapse along with it, because these are stock up, vol up, and that it's really the call skews that are really jumping. And so, we are dropping indeed pretty sharply here. But this should ultimately lead to that vol collapsing. And I think that vol will collapse before the stock goes to zero. I mean, I don't know anything about the fundamentals of this company, but I just don't think we go from 12 to zero.
Yeah, exactly. And the beauty is, even if we do, I mean, the most you can lose is $3.
Yeah.
Because if you sell a 3-strike put, right?
Yeah. Well, I'm sure you sold 50,000 of those. So I guess you lose $3 in trouble.
For me,
Anyway.
It's one of those trades that you want to do just to be involved, because it's kind of a bit of fun.
It's fun, yeah.
Yeah, exactly. You never do, because this is not my wheelhouse, trading AMC, right? Like I say, I don't know anything about this stock. I know that the vol surface moves in funny ways, and for me, it's just, as a general rule of thumb, when the market goes up a lot and the value of a put doesn't drop, that put is a sale, right? And it's the same thing, like when the value of a call doesn't drop when the market drops, that call is a sale, right? Anytime the option premium does the opposite to what it should have done because of its delta, it means that the vol has overcompensated for the delta, and therefore there's a very high chance that that option is just a naked sale. Right?
I like that phrasing, vols overcompensated for the delta. All right, so that's kind of me mania here. The call volumes, I would just also say we hit 600,000, total options volume in GameStop yesterday. We were trading 2 million back in 2021, 2 million contracts a day. So, this is fun to talk about. I just think it's a flash in the pan. And I do think that, back to your very original point, institutional flows and trades are waiting on all of this, right, to happen again. I think market makers widen out markets much faster now, which stops the rally. But to your point, there's a whole bunch of other HFT style shops that probably come running in here, knowing what the playbook is, knowing how to take advantage of this. And so, if you're on the retail side like us, then hopefully you made some money initially. But I think the thought that this is going to go to be, January 2021 repeat, probably unlikely. All right, let's switch gears here a little bit. It's been a very interesting market, I would say, over the last month, because we had finally a little bit of volatility from the all-time market highs in April. We hit 52.65 in the S&P. Everything was looking good first week of April, and then all of a sudden we dropped very sharply. We were down 5%. And there seemed to be a pretty big unwind. There was the geopolitical risk, and then there was the scare of higher rates. S&P bottomed on April OPEX, which was the 19th. Here's the VIX. The VIX peaked on April OPEX. And then suddenly, as you can see here, after FOMC, vol got sold, the dip was bought, and we are right now back to this 52.25, just below all-time highs, right in front of the CPI print. PPI was today. No one cares, whatever it was. CPI, everyone's focused on tomorrow. What do you make of that April drop before we talk about what was coming up? Do you have a way to frame, what you took from those flows into April OPEX or out of April OPEX, and how that maybe sets the stage for where we are?
Yeah, I mean, on those, I'd called that vol sell off. I was telling everyone on Twitter, on X, to buy VIX puts. That was the best risk reward trade. I think we discussed it in the chat that we had as well. And it was just, there was generally seasonality for index vol to go down. The spike was being driven by geopolitics that has a half-life. Generally, if we're not about to go into World War III, then, that geopolitical news, as it de-escalates, vols are going to come back down. You were seeing, as the spot was going down, you were seeing fixed strike vol not really reacting on the downside as well. So there was a few telltale signs to suggest that vol was kind of exhausted a bit to the upside. And so there was a decent risk reward of it going lower. So we've got that. I mean, it's amazing how quickly vol does go down when it goes down, right? It usually goes down even faster. Like in the old days, when I first started trading, there was this kind of old adage that was like, vol explodes really quickly and it drifts back down.
Mm-hmm.
But it's not really the case anymore, because whenever vol goes up a lot, there's so many people waiting to sell it because it's such a high probability of success trade,
Right.
that it just collapses just as fast, if not faster, than the way it went up nowadays, right? So that's what we had on the way back down. I do think it overshot a little bit going to 12, which is why I covered my short vol positions last week, but looking for a little bit of a pop in the VIX ahead of CPI that I could maybe sell into. But it doesn't really look like we're getting that much of a pop in the VIX. So
Yeah.
it may just be you don't get the opportunity to sell it, because even after CPI, generally vol resets pretty fast. But it's already beaten up. It's already quite low. Realize has been hanging in there. It's been drifting down a little bit, but it has. If you look at 1 month, realize it's not that bad. So maybe vol doesn't have tons of downside right here, right now. And for me, it made sense to cover shorts just because, you'd rather sell it when it looked a bit juicy, and it's not really that juicy anymore.
Yeah, here's a 1 month realized you can see there on your screen is about a 12.5. And so if you look at the VIX at 13.5, that's not a whole lot of, just a finger in the air barometer of volatility is not that high, because that realized is pretty high, to your point. Now, what's interesting though is even though realized 1 month is not very high, the last week has been a real snoozer, and the market really hasn't done much at all. As you can see on the chart here, we're really hovering around this 520 area. And indeed, to your point earlier about, CPI, if we look at the term structure here, tomorrow there is a big implied vol premium assigned to tomorrow's expiration due to that CPI. And I just think that unless this is a hot number, which, who knows if it could be, you have to default to this getting sold off. And then the market, I think, has a pretty decent chance of moving back up into this 5,200 area because of the reaction of people wanting to sell these short-dated options. So I think we're going to be, my default is we're looking for 5,265 to 5,300 by Friday options expiration is what I'm thinking. Mm-hmm. And we did a study, and what we actually found is that like 90% of the time it's an overwhelming majority of the time, volatility contracts into options expiration and then expands after options expiration. Now, that's not a window of weakness statement. That's a volatility expansion statement. And so if you think about how tight the market was here over the last couple of days, not really moving last week in particular, and even today, I think tomorrow the CPI clears, then you get options expiration is going to adjust some positions. It's not a massive expiration. It's just a kind of a regular monthly expiration. Mm-hmm. But then we turn to Nvidia and Nvidia earnings. And before I get to that, I wanted to throw this idea past you. Throughout the start of 2024, one of the big themes was correlation going lower. This is as soon as I can format it correctly. This is 1 month correlation, the S&P. If you look at 3 month correlations, the SIBO metric, it's at or near all-time lows. And what this is it measures S&P at the money implied vol versus the implied vol of the top 50 stocks in the S&P. And if this goes lower, it tells us that correlation is kind of breaking down. And the reason that correlation was lower was, in my view, because people were chasing certain themes throughout 2024, obviously, Nvidia, semi-stocks, AI, et cetera, right? Now, the reason I want to talk about this before we talk about Nvidia is because if you look at the way that correlation moved, particularly bring up core 3M, which is the 3 month correlation, so it looks at 3 month options, you could see here into March, it hit major lows. And then in April, it snapped higher, right? Because all stocks kind of went down on this geopolitical rate risk. But I was looking specifically at Nvidia. Nvidia was up 100% year to date into the start of the month. And then it lost 21% into that April crash, and now it bounced back up. So I looked at so much of the April flows, kind of reviewing everything as this kind of correlation, if you want to call it poor market breadth, people chasing certain sectors. Remember how high those call skews were back in March and into April? All that sort of unwound into April, which added to a lot of the volatility of the downside, particularly single stock vols. And now, yes, Nvidia's bounced to highs, but the call skews, which you can look at shortly, they're nowhere near as high as they were back in April. So we sort of just like flushed out some of the overbought conditions, which is ironic because, as you can see, a lot of these stocks are back to where they were before. But from an options perspective, that call implied vols are relatively lower. So my question to you is, do you sort of agree with this idea of a general reset is what we just sort of went through? And then part two of that question is, do you think that we can get correlation driving back down, and can we lead markets higher if Nvidia earnings are very strong and we start to get a thematic bid back into these semi stocks?
So something I've often said about correlation is I think it's largely driven by rates volatility.
Mm-hmm.
So I think when there's a lot of rates volatility, different sectors get impacted in different ways, and you get quite a lot of dispersion, right? Rates volatility has started to decline quite a lot recently, right?
Mm-hmm.
So if rates volatility declines, that's probably supportive for the market in general, but that probably means all sectors kind of go up together, in my view, right? So I would actually think correlation is already quite cheaply priced. It doesn't need to drop much. So what that says to me is correlation is already low. If the market rallies on lower rates vol, it will take all sectors kind of with it. It won't just be necessarily just led by AI and Nvidia type names. And as that's happening, because the implied correlation is already so low, index vol on the upside will hold up really well. So the VIX will just stay at 12. The VIX won't go to 10. So if we rally to new highs in the next few weeks, because inflation data is good and it's good and all that stuff, expect VIX to still be on a 12 handle and the market to be on a 54 handle. Basically, that's what I reckon.
That's interesting. To your point on cross-asset vol, this chart is from the SIBO here. We did a OPEX effect podcast today. Go to youtube.com/excess returns to check that out. But this is cross-asset vol. It all spiked, to your point, in mid-April. And according to the SIBO metric, all that's left here is gold vol, which is high. I'm sure if you did copper, it's probably up there as well. But, FX, credit rates, all that vols just come back down to where we were. So we just round trip this whole thing, which I think is interesting. I think that we have a possibility of the VIX tagging kind of new lows, because I think realized vol is going to continue to sort of contract here. But before moving past this Nvidia, where 900 is indeed a big strike, I see a question in the chat on that. Nvidia is the biggest strike. We can take a look at that momentarily, but this is Nvidia's skew into earnings, which is not this Wednesday, but next Wednesday. So, obviously skew and a lot can change over the next week. But I wanted to show that if you compare this versus a month ago, so if you remember, mid-March was the GTC conference. Sorry, it's 2 months ago. That was the GTC conference, right? Kind of their, announced their new products, and that was a real high for the market. And so if you compare 1 month vol, what you really see here, and we can look at it on a delta basis or any other basis, you can see that how much higher call skews were into that event, right? They were just very, very rich. And the probability of paying off in that situation, in our view, is very low, because the minute that event passes, that event vol is going to come down. And so they really had to just absolutely blow the doors off in order for that vol to pay off. Here you can see that, it's pretty flat. The skew is pretty flat, which I think is interesting. And I think a signal that if earnings are good, the stock could really start to stick closer to that 1,000 level, as opposed to tagging it and selling off violently. You have any comment here on I know you're probably just looking at this for the first time, but any comment on the relative skew here between that very rich, mid-March period and what we see now?
No, I mean, it's a really good observation. What it would say to me is there's clearly less speculative buying of calls this time around. So there's less expectation built into these earnings.
Yeah, 100%.
So if they are actually really strong earnings, then the stock actually probably has a lot more of a rally than normal, right? And then on the flip side, if they're kind of whatever earnings, the vol isn't so pumped that there's this massive vol reset that basically gives you a Vanna impact of loads of stock needing to be sold back out, basically.
Right. Yeah.
So essentially, I guess that means the disappointment drop doesn't need to be as bad, right? And if they beat earnings in a big way, then the move to the upside could be that much more violent. That's what it says.
Yeah, and if it's a banger, like if you remember too, in February when they reported earnings, which was here, This was the last 2% rally that we had in the S&P 500 intraday, which was the first rally in, I think it was 400 days, 2%, intraday rally. And we haven't had a 2% rally, I don't believe, since. So that earnings beat really moved the market. And there's always charts getting passed around that even if you own the calls, right, like you didn't make any money because implied vol dropped so much. It's not the same situation here, and I'm glad to know that you feel somewhat the same. I want to pause here real quick before, Nvidia is not a meme stock, but it's meme adjacent. Here's the giveaway for the t-shirts. If you are interested, you can go to spotgamma.com, and we're just going to raffle some of these off. So we got about 15 shirts. You got to put your size in because I only got limited sizes of each. I'll put this link in the chat as well.
You're saving me one, yeah?
I'm saving you an extra small one. I hope that is
extra small. Thanks for that. Yeah, appreciate that.
I can't post it, so you can type in this URL directly if you want. I can post this on Twitter maybe too, but if you just scan that QR code, we'll send you out a free shirt. Why not? And anywhere in the world, we're open to shipping. Anyways, back to the market here. So setting this whole thing up, back to the original point before I broke off for the Nvidia diatribe. We have obviously, again, CPI tomorrow. We have OPEX on Friday, and then we shift to, I think Powell has a speech on the 19th, and then we have Nvidia earnings on the 22nd, as we mentioned already. VIX expiration is the same day. So I want to get your take on VIX expiration. And then we also have FOMC minutes as well on that same day. So I think we're going to have, the market's going to have a real consensus, not that it doesn't already, on rates, right? Because, rate vol, so we could argue that nobody cares. But we're going to clear away any type of chitter chat around rates, I think. And then get this maybe catalyst out of Nvidia. So, is it too unreasonable to think that we could start to get a real breakout here? I think if we go under 5200 for any reason, we're going back to 5,000. We're going to break fast. But is there any reason that the market can't go to new all-time highs from this position?
I'm expecting all-time highs, for sure. Not for sure, but I definitely.
I think you made a guarantee.
My base case. Huh?
I said we're not allowed to make guarantees over here.
No, exactly. That's what I'm saying. But gun to my head, I'd expect new all-time highs, like by, the summertime, if you want to call summer June, July. I think it's a very, very high probability of that, the way this market's trading.
Yeah, and I think that it's also interesting to me that for how much attention the CPI, PPI data gets, that vol, the rate vol, is just so low, which tells me that, what was funny when we were doing the charity day last week, so much of the discussion was on kind of the over emotional Twitter landscape that we are all in, or X landscape that we're in every day. And, every data point is the most important data point you've ever seen. Well, if you just look at vols, they tell you that no one really cares. And there's two sides of that coin. Side one is obviously, well, people aren't paying up for puts, and they should because volatility is about to enter. But the second one, like longer dated vol, you could just see that it's very calm out there, right? No one is really concerned about this market movement. And so, how do you parse through those things when you're looking at long dated vols and you just go, look, we're at lows. The VIX isn't really doing much. Here's term structure. It's at 90-day lows. It was a pretty calm period. Nobody really cares. So how do you ever know, like, hey, look, this is telling me I can be bullish in this environment, or it's signaling to me, hey, I need to start buying protection because vols are cheap and people are underpricing risk?
Yeah, I would say, one way of taking advantage of these really cheap vols, if you were worried, would be to just switch some of your longs into calls, basically, right? Mm-hmm. So stock replacement. So, is that the S&P term structure you've got on the screen?
Yeah, it is.
Yeah. So how far out does that go? What's the longest?
This is going out to September here. We can extend that to the election.
Exactly.
There's your little election bump there.
A little bit of a kink in the election, right? So you could go, but the truth is, if we're going to rally, we're probably going to rally kind of into the election, right, to some extent. So I think owning September call, I've actually got some of those. I've got some September calls on the SPY in the book as a bit of a stock replacement. It's like, okay, I'll participate in the rally if it comes, but if it decides to go down for some reason, I'm going to lose a very limited amount, right? Mm-hmm. Because the vols are the vols are very low, and it's not like you've got this really steep term structure. Like historically, the S&P term structure has been much steeper than this. So you'd have the front end being compressed because realize is nothing, and there's loads of systematic sellers, but you'd have like 6 to 12-month vol really, really steep and actually pricing in a lot of term premium. But actually nowadays you don't have that for whatever reason. Maybe there's more sellers across the rest of the curve, but when you've got vols that cheap in the medium term, like the 6-month type area, then you've got a really cheap way of participating in the market, I think, owning calls.
Yeah, I think that makes a lot of sense when you say it. I mean, you could use that optionality to your advantage to play that upside. And to your point here, if we go out, several months and we just look at, pre-election skew, certainly here's 1 month in green. And what you just see is that the implied vol is, again, similar to term structure, as low as it's been in the last 90 days is what that shaded cone is. And, no one really seemed to want to own puts even in the April weakness. And so, what's to make them hedge here when we're at all-time highs? We have this meme mania situation coming up or percolating, right, which is a risk behavior. I guess if CPI is hot and you get really bad numbers out of Nvidia, then maybe that really turns the tide. But I also feel, and I want your opinion on this, is that once we clear, let's just say Wednesday, and yes, there's inflation data points I don't know anything about Treasury, blah, blah, blah. But we had the election coming up in November. And I think that there's just a 3-month, 4-month period, coming up here, pre-election period before we start to get into the concerns and consternation about it, where, kind of for the summer where we just sort of cruise, because I do think that markets are supported into elections and policies are going to be more accommodative than normal. And so, is this not a decent spot for things to really break out and start to move, assuming CPI is benign and Nvidia earnings are good?
Yeah, I think the only thing really stopping a material breakout would be just the street is quite long gamma, right? So, I think if the street's long $7 or $8 billion of gamma up here, then there needs to be quite a lot of buying to really drive us materially higher. Now, apparently, systematic funds, as vol comes down, like CTA, risk parity, vol control, those types are going to be buying delta. The corporate buybacks are back in full force, buying like $5 billion a day. So there is buying. So that buying may potentially be enough to drive us away from these long gamma strikes that we're at. And then you've got new gamma coming all the time, right? Fresh, new, short-dated gamma selling, whether it's weekly, whether it's daily, whatever it is. So those are the things that prevent the market going up too quickly. But yeah, I agree with you. Like policy-wise, Powell's pretty much pushed back on any idea, on any chance of hikes. We would need to see, not just the slowing down of inflation, of disinflation. We'd need to see some really aggressive inflation for them to make that switch to, oh shit, we might need to hike again, because that's not where they're at, right? And you look at other central banks, like the Bank of England is due potentially to cut in June, and the ECB is signaling that. You just had the Riksbank cut it just recently. So you've got a load of other central banks already cutting. You've had the Fed that was pricing in loads of cuts has now got quite hawkish, relatively, only pricing in 1 or 2 cuts. So now there's loads of room for them to price more cuts back if the data allows them. And they're gagging to do that, right? Mm-hmm. Because there's kind of what he's signaling. So I think that backdrop is that backdrop is a bit bearish for the dollar, and it's quite supportive for risk assets, basically.
You bring up a cadre of good points there as well, because that global equity vol is also very low, and as you mentioned, and people or central banks are starting to get more accommodative, just writ large. On the point of positive gamma, like JEPI is the biggest of the overriding ETFs. I think there's 200 billion roughly of gamma is what the recent report said. I think this thing keeps growing, and so it's selling 1 month roughly 20 delta options in the S&P 500, and these style of products just keep adding positive gamma, and that positive gamma is largest, in and around this area, right, 5250 to 5300, and that is just rolling positive gamma that is getting glommed on. And then with the zero DTE options, our studies have shown, we just did another recent study, that short dated options bring mean reversion to the market. It's a supportive market. So instead of opening at the high and closing at the low or vice versa, we tend to get markets that now move back towards the mean. And so, you bring up all these, I think, really good points, that there is this technical nature to the way the market trades, got financial engineering, I think, whatever you want to call it, that is just very supportive of things. And it makes it hard for the market to have, I think, material sell-offs, which, look, we haven't had a really material sell-off. Okay, 5% in April is a rough bump, but look at how just linear this move was, right? I mean, that's not a very technical analysis, but you could see there was no dips.
And also notice that whenever it does sell off, it rallies back pretty damn quick. Like, it just doesn't stay down for very long.
Yeah. Right? Yeah. And right back to the level where it previously was, right? At least in this case, it was just a very, violent move down and violent move right back up, and, right back into this real neutral zone. Someone here was asking a question for you. Raghav said the move index is making big moves today on the PPI number. What if anything, is a hot CPI enough to really, bring this inflation thing back to the forefront? I thought PPI is what the Fed cared about. I don't know, market didn't really seem to react to that, whatever the data was.
I'll tell you my thoughts on the rates, right? So I don't think we're going to get a very hot inflation print, right? The owner's equivalent rent chart has been out there. People are saying that leads the CPI, and it should come down. So if that happens, then I would expect rates to be lower. But the question is, where on the curve are you going to get the most bang for your buck, basically, right? I don't necessarily think you are going to get it in the long end of the curve, because whilst bonds may rally, there's also that fear that if they cut rates aggressively this year, then longer term inflation is not beaten, basically, and may come back. So I'm not sure the long end really rallies that much, like TLT, for example. But I think the SOFR futures, which are essentially the short end, I think those could really rally, right? And they could price in an extra cut or something. They could do a quick 20, 30 bips on the front end, but it prices in another cut. So I would play it via like call spreads in SOFR if I was going to, and I've done some of those actually, because I thought they were quite cheap, right? So like you look at, what expiry was it? Something like September expiry SOFR futures. You can buy those call spreads for like 5 cents for a 50 cent wide call spread, get 10 to 1 payoff on the money. It's very unlikely that it's going to smash through that whole call spread, but the risk reward you're getting, because SOFR vol's really cheap as well, just like the move index is, I think you're getting quite nice asymmetry in owning bullish rate structures to play a miss on CPI, right? So that's kind of how I'm thinking about it. That answers their question.
Yeah, I mean, I think it does, and maybe this PPI number is moving things a lot more. But I would also say that and correct me if I'm wrong, but the market was pricing in many cuts at the start of this year.
Six cuts, I think.
Now the market's maybe pricing in one later this year, but S&P still at all-time highs. So I don't know what it would take for that rate stuff to really matter again. But I
guess the point being there, what you just made, is there's probably more juice in playing the rates going lower than there is in playing the S&P higher on the CPI number, right? Because if the CPI number is a miss, like the equity market has kind of already like rallied for the fact that the Fed is dovish, right? They had that in the FOMC, the fact that he pushed back on rate hikes, that was the move that took the S&P higher. But the rates market hasn't actually moved that much, right? Back the other way towards cuts. So if it's a big miss, then it's the dollar and the rates market that have got the most potential movement on that one data point. That's not to say that we're not going to rally on S&P and go to the moon and go to new highs. We probably are. But just on that data point tomorrow, if it's a miss, what's the vol adjusted move going to be best on? I think it's more likely to be the dollar or rates, because those vols are on their knees and they haven't moved that much, those things.
So, sorry, we're having a couple of complaints on the T-shirt link not working. So if you're having that problem, let me know. Sorry about that, Imran. Looking at the dollar and FX vol, one of the things that was moving so much, which made me spark this, is that I think, was it into the last OPEX, we were talking about the yen and how much that was moving. That story seemed to kind of go away pretty quickly. Any color on that? And sorry, I tried to bring up the old quote here.
All I'd say on that is, everyone was crapping themselves about intervention. That's why there was a load of put skew on dollar yen. It was trading on the moon. Then the intervention happened. We got whacked, but we kind of chopped around, digested it, drifted back up, and now that skew's just completely collapsed back down to the lows, right? So now the market's just like, okay, they've done their intervention, they fired their bullets, and now we're not overly scared that that dollar yen's going materially lower, basically, right? That seems to be the way it's played out. Well, I mean, I haven't got a strong view on dollar yen here, to be honest. I mean, they probably are going to fight it above 160. So they fired their bullets when it touched 160. So they've kind of drawn a bit of a line in the sand, say we don't want it going above 160. But will the market test their resolve? If yields go higher in the US, then yes. But it doesn't look like yields want to go higher right now. And if we were to get a miss on CPI and bonds are going to have a bit of a rally, then actually dollar yen maybe kind of stays here or goes lower if US yields go lower.
But a question on this, Michael here says, is there any nation in the world that has high central bank interest and low inflation? I don't know if that one is inside your macro pay grade there, Imran. I don't know how much you cover that, but
I'm going to pass on that one. That's a question for our friend Darius. You'll be able to answer that in 2 seconds.
You'll get a serious answer from Darius, no doubt about that.
Yeah, totally.
And everyone, I know if you've been kind enough to go to the link or generous enough, whatever it is, to go to the link for the free t-shirts. I understand there's a problem with the forums. The team is working on that, so I apologize on that specific item. Imran, turn into sort of single stocks. I know we covered the meme mania topics. We saw that gold vol is still pretty high, copper vol is still pretty high. I don't know if you have any views on that or any specific single stocks you want to cover. And then, of course, in the last about 10 minutes, we generally take audience questions. So anything on the single stock or commodity side that's really jumping out at you?
Yes, on commodities, I've been taking the elevated vols as an opportunity to do call overwriting. So I've been long commodities in my long-term portfolio for a long time. I've got some names like Kamiko for uranium and Freeport McMoran for copper and stuff like that. So given where they got to in their ranges and the vols elevated, it was a bit of a no-brainer to call overwrite them. So I started call overwriting them last week with June calls. So I think that's a good opportunity. The only other name in singles that I really care about right now is Apple, right? I mean, I kind of called before earnings that Apple was going to rally into this big AI conference unveil that they've got going on in June. Now they had better than expected earnings, and there was news about ChatGPT coming into the iPhone basically. So they've already started rallying, but who's to say it doesn't get to 200 by that conference, right? I mean, I think people are starting to cotton on that Apple have figured out that they need to join the AI race, and they were left behind. And now they're making changes, right? And those changes, the way they tend to operate is when they do something, they do it well. They do it properly. Right? So I would certainly back them. I'm long the stock. I did some calendars to get long. I've rolled them into outright calls now. I'm sitting long June calls, trying to ride that rally in Apple, basically.
I think you bring up a lot of prescient and interesting points. I thought we saw signs that 170 low was being sold. Vol is lifted like a tiny bit ahead of this event, as you can see here with 1 month skew for Apple. It's still pretty flat. So you get the impression, kind of like in Nvidia, that there's not this kind of demand where everyone's jumping on that same trade idea that you have, which I actually think means that it has a better chance, right? You don't want to ever buy into those call skews are too high.
I also think that's partly because from what I've been told, I haven't seen it myself, but from what I've been told, there's a fair amount of call overwriting that goes on in Apple because it's like such a big name, right?
Yeah.
Everyone's long it that there's a lot of just like there's natural call overwriting on indices. I think Apple's like an index. And so there's a lot of call supply that comes. So even if there is a reason to own it, if that supply is systematic, those guys aren't going to not sell their calls because they want their yield. So I think that might be keeping a little lid on it.
It's not a bad idea. And on this topic, because you just mentioned that you were selling calls in some of the commodity names that you're playing, When does it jump out at you that this is a good opportunity to overwrite call positions rather than say, hey, maybe the lifted vol is suggesting that people are buying these calls, and so I want to give it a little more room to run. Is there a certain parameter that you look at and say, okay, now's the time for me to sell calls? And then what calls do you default sort of looking at? Is it 1 month, longer dated? What are your parameters there?
Sure. Part of it is just like looking at the momentum in the stock, right? Is this the first time it's testing this level on the upside? What are the momentum indicators looking like? Are they like at the highs, or are they showing divergence? Things like that. So if the momentum indicator is really, really high, some people will look at that and say, oh, it's so overbought, so you want to go short. But I stay clear of that, because generally that's not an exhaustive condition when momentum's at a high. So when you're making new highs in a stock and momentum's at the high, yes, it's super overbought and it probably will correct, but it's impossible to know when. So you'd rather wait for it to correct, then retest the high, but on weaker momentum, and then then the move looks more exhausted, basically, right? So that's kind of when you're more comfortable launching some upside, because it looks like a more exhausted rally, basically, because it's the wave. Also, if you look at waves, like Elliott wave analysis and stuff in technicals, you kind of don't really want to be selling into a third wave. You want to wait for a fourth and a fifth wave, and you want to be selling into a fifth wave, because that's the last part of the move, and so you're more likely to kind of stall out, basically. Yeah.
Those are great insights. I tend to look at sort of where the options positions really start to wane, on the idea that options positioning can help drive momentum. You can also look at here. This is Apple. By the way, if anyone's interested in trying out our implied volatility tools, it's a free trial, SpotGamma.com. Try the alpha membership, 1 week free. But what you would see in names where it's obvious is where you start to see implied vol lift over its range, which is this shaded cone. And here we have Apple. This is from comparing February's implied vol level. So February is back when the stock was near 200 and really moving, versus now. And kind of to your point about a lot of call overwriting, even though the stock had so much momentum, you could see that it never really generated a major call skew like you'd see when stocks are really catching a bid. Jay also mentions in here that Apple has $110 billion on buybacks on tap. I don't have a way of fact checking that number right now, but I'm sure there's something.
Yeah, no, that's right. They announced that on the earnings. Yeah, that's right.
Yeah. So that's all. Those are some great insights, Imran. And then my buddy Bill Klein here is asking about dispersion. And his question is, any thoughts, or he's looking for some thoughts on dispersion with single names moving. And I think that relates to this idea of calls catching a bid, Nvidia moving up, single stocks becoming interesting. What do you make here of, this is the SIBO dispersion index, but what do you just make here of the dynamics between single stock vol? And I know we touched on this briefly, but I just want to recap this question.
It looks a bit exhausted to me, like as in there was a chart going around that I saw where it looked at like the average realized vol in all the tech names divided by the VIX or something like that, as like a gauge for S&P, and that ratio is at a high, basically, right? It's like really high. So it's saying that we are dispersing as much as we kind of ever have, right? So to me, I think the odds are, like, if we have a flat S&P for the next 3 months through the summer, then yes, the dispersion is going to continue, right? But if the S&P breaks to new highs and we go to 5,400 or even more, then I think that will be a more correlated move where all sectors will rally and the market will just kind of go up together. So I don't think you're going to get as much dispersion. So I think it's conditional. Whether we get dispersion or not is going to be conditional on if the S&P is flat or not. And I don't believe the S&P stays flat.
Yeah. Sablat, I hope I pronounced your name right. He says, we're ignoring the years when the market was flat into election years. We could be flat or stall out here, which I think on the index side is reasonable. I don't think that's true of the single stock side, mainly because we have this earnings catalyst. And I think we can really glom back onto this narrative that AI and chip sectors, that can be the savior. Plus, there's the mixture of rates shifting a lot, passive flows, these gamma dynamics. I just think there's so much now that happens from a financial engineering type space that it's markets are just different now than in past years. And maybe I'm a little bit wrong in that view, but I just don't think we can just stall out altogether. But I suppose we would see. The other thing I would take away from this related to your comments, Imran, is that we were just looking at the Nvidia implied vol. There's not a lot of call skew there. Apple tends to, I guess, have a lot of call skew, but those vols seem pretty low. So these vols are, in a way, reset on the single stock side. At least it appears that way to me, with these stocks still kind of near all-time highs, right? I mean, you look at any of these names, we don't have that same frothy feeling, but everything is just a touch off all-time highs, right? And I do think that new all-time highs, and you look again at this meme mania bid and all stuff, it wouldn't be too hard to start generating a new bid in the call space and see those single stock vols really lift.
Yeah, I agree. But it might be a more grind. It might just be a more grindy move now. It might not be as explosive, right? It's kind of like, those, like you said, those passive flows, those buyback flows, they'll come in and take the market higher, but it won't necessarily be like a surprise where you get a massive move in rates and you get you get these big shifts that are really surprises to the market. I'm not sure we're going to get that. I think I'd probably go for that more grindy scenario. I'd favor.
That makes sense. So on that last thought or idea, I tend to tease, and if you look historically at, and I just want to leave on this kind of thought, I hadn't checked this yet, so we'll check it in real time and see what it looks like. This is the JEPI overriding fund, and it has this big assets, and it has a yield, I guess you want to call it, of 7.3%. And the idea is that I think it's mostly dividend, or income investors are attracted to this thing. If you do think there is a grind, is there any reason you wouldn't want to just own, say, something like this versus the spiders? I mean, this is the year-to-date performance. As you can see, it's not all that great. Is there a situation if you're going to get this grind that maybe you do want to pivot to one of these call overriding ETFs for any reason?
You know what? I think it's one of those things that if you're bullish, just have a bit of everything. Like have a bit of the long with the call overwrite, have a bit of September calls on the book. You know what I mean? When you're overwriting, you generally want to be shorter dated stuff, right? Because you're going to earn your theta quickly. Mm-hmm. So yeah, I would have an allocation in this. I wouldn't have a problem with that. But then I would also want some outright set calls in case the move happens a bit quickly and vol actually resets higher on a rally, which it could easily do because of the implied correlation being so low, like we discussed, right? So that's the way. Rather than trying to kind of rack your brains like what's the optimal, what's the best scenario, I think you want to have a core thesis and you will find a few different ways to express it that kind of cover your bases a bit. Mm-hmm. I think there's value in doing that.
Yeah. And from a padding perspective, you can see the JEPI here. It still went down pretty hard for the underperformance you're getting. You're not getting a whole lot of padding. Last thing here on term two.
You're getting no premium. You're getting very little premium, right? Like collecting every time. It's very slight premium you're collecting.
Yeah, it's interesting that it gathers so much assets, I guess is what I would say at the end of the day. Last, I wanted to bring up small caps here because I think it's interesting if inflation starts to come down. This 210 level in the IWMs is a big one. There's, I think, big support at 200, I would argue. Is there any scenario in your mind here where small caps do start to significantly outperform? I mean, is lower rates all that it may take, or is there some other kind of larger shift?
I saw this chart of junk credit spreads widening quite badly against regular high grade stuff, and that in itself wouldn't make you want to go into mid caps, right? So I don't know the ins and outs of like which names in the Russell have bad credit, that have credit that is widening, but just as a general sort of observation, there seems to be a divergence between junky credit and high quality credit, and therefore you probably won't see, in that condition, you probably won't see a massive outperformance from small caps.
Yeah, someone else brought up an interesting feature of small caps as well, in that this was pertaining to SMCI, which really stuck with me, and I don't know why this hadn't struck me before. There's that SMCI, was in the small cap index. It blew the cover off the ball in terms of earnings and everything, and then immediately got kind of upgraded, so to speak, to the S&P 500, and it's not in the small cap anymore. So it's like, well, that was your top stock, and you naturally just lose it. So you're kind of stuck holding the bag in a way with IWMs, because the best performers are naturally going to sort of
they leave
drift
the index. Yeah, that's really interesting. But then when they leave, what happens when they leave? You basically that exit means that all the other names get bought in smaller in some quantity, right? And they get dragged up. But then those stocks aren't necessarily good quality stocks. So then, yeah, that's true. Yeah,
you're culling the top names out. It's like the opposite of the old Jack Welch thing, where you fire the bottom 10% of your employees. Like this one's, you're like, get rid of the best, which is really interesting. I'm sure there's been some papers or something on that. For those of you who did try the meme mania link before in the order form, there was a problem with it. The order form has been fixed. I have confirmation of that for some nice users who put the comments in there. So go to this link, spotgamma.com/meme-mania-raffle. You get a chance to get this shirt, Meme Mania. Enjoy it while it lasts, because these names here, GameStop and the like, are coming down a little bit. We'll see how much this holds on. So a couple more minutes to grab that link before we end. Imran, as we hit the top of the hour here, I appreciate your time as always. What's your just give us the quick synopsis you're looking for over the next couple of days. Let people know how to find you, and then we'll wrap this thing up.
Sure. Base case, I'm looking for a bit of a miss on inflation and a move higher in markets, maybe up towards that level.
Miss meaning inflation comes in light.
Yeah, inflation comes in light. We see the dollar get whacked. We see S&P up to maybe 5,300-ish. That into Friday. That I think that's a fairly realistic scenario, and one that I wouldn't really want to fight against. If we got a knee-jerk drop on a hotter inflation print, I'd be a buyer of that drop at around 5,200. Yeah, just because I think there's a lot of gamma in the market that's going to basically come in and need to buy deltas against that. So yeah, I think that's the risk reward. I think we either get the direct rally if it's a miss, or we get a knee-jerk lower and a recovery, basically.
Yeah, that syncs up a lot with me. I think if CPI is in line or under expectations, then we're going to be in this 5,265 to 5,300 area into Friday expiration. And then I think if Nvidia earnings are good next week, that we really start to really break out of new highs in the end of the month. My risk off number is 5,200. If we break that stops out on my bullish lean here, and I think we would very quickly trade down to this 5,100 to 5,000 area. Vol would spike quite a bit. In which case we may have, an extended period of kind of consternation in markets.
Well, one point on that though, there's not as much VIX call open interest as there normally is, which is why the VVIX is hammered. VVIX has got hammered. So if you did get that break lower, if there was a lot of VIX call open interest that was fueling that vol spike, then it might get a bit more dramatic. But I wonder the fact that that's not there, if that, maybe I'm talking my book because I'm not bearish, but it's you might not get as much of a VIX move because there's not as much calls having been bought that people are going to have to chase their tail on the VIX higher, basically.
The positional flows are just not there to really exacerbate that.
Yeah.
And we were ready to wrap this thing up, but I wanted to bring up this other interesting thing that, call volumes haven't been that high into this rally. They certainly moved up, but they haven't been really high. Look at this. This is just equity put volume minus equity call volume, right? This was the lows. We flagged this in the founder's note, said, look, this is like a real standard deviation move here in put volume relative to call volume. And so the volume it's so transient. It's just like one day we're all buying calls, next day we're all buying puts. It could just turn on a dime. And we're starting to see that call bid build a little bit here, as you can see. So that's an interesting note that people are backing off of that call volume, and because the put volume seems to be, and this is single stock, seems to be kind of really pulling back as well. So it's an interesting dynamic that maybe there's not much full support downside, particularly we have this big positive gamma environment that's helping to absorb things. So really interesting comments there, Imran. Thanks a lot for that. Mentioning how people can reach you put a bunch of great stuff on Twitter.
Yep.
So let people know how they can get a hold of you.
Sure. So I'm options_insight at options_insight on X. And our website is options-insight.com. You can come and see what we do, what research we provide. There's tons of stuff on there for you to get your teeth stuck into. And we offer everyone a free trial for a whole month as well.
Yeah, thanks for that, Imran. You can reach me at SpotGamma on Twitter. You got another 10 seconds-ish to scan the QR code there or go to this giveaway link to enter the raffle for a free Meme Mania t-shirt. You can reach us at spotgamma.com. You get a free 7-day trial of all of our stuff. We would love to see. And if y'all have time, you can go to the SpotGamma YouTube channel. You can see Imran and I kicked off a charity day we did a couple weeks ago. There's still an opportunity to donate to the Susan G. Komen Center for Breast Cancer Foundation. We had incredible guests on there, 20 plus guests on there. And hopefully all of you found value from those conversations as well. And so we're going to wrap it up here. And Imran, we will be at a minimum seeing you already in June. Year's half gone. June OPEX. I'm sure we'll likely be meeting and chatting about something before then. So thanks.